Welcome back. You're watching The Money Show on ET Now. The big bull, Rathi Jhunjhunwala, gave his very first television interview of the brand new decade to none other than your favorite channel and his managing editor, Nikunj Dalmia. Now, he believes the time is ripe to buy, and definitely one can check into gold as it will glitter, according to him, amid lower rates. Listen in.
I think gold is one asset which will really perform well.
But do you think gold in financial markets or gold in equities can go along hand in hand?
Sure, why not? Gold is a very, very small part of the total. I think the total value of gold in the world will not be 2% of the total financial assets. So why can they not go up in unison? And gold will go up, I think, because in my opinion, interest rates will not go up. And statistically, China and Russia and other countries which have $5 to $6 trillion of reserves, foreign reserves, they want to diversify from the dollar. And the only currency they have other than dollar is gold.
So, the big bull seems to be pretty optimistic on gold, which, by the way, has had a great year, almost a 25% rally. In fact, go over to a shop to buy gold and he will perhaps charge you in excess of 40,000 rupees, perhaps even more than that, 41,000 rupees per 10 grams. And now, of course, billionaire investor Rathi Jhunjhunwala believes that, look, gold may actually go higher from these levels as well. So a lot of you guys, I'm sure you guys already have gold lying in your lockers, heirloom jewelry in many ways. But what if you want to take gold as an investment? Here is an option. The sovereign gold bond schemes, which incidentally just around Rathi Jhunjhunwala's interview has launched Series 8. It is open for subscription now all the way till the 17th of January. And that's the price that they're offering, 4,016 rupees per 1 gram. You get a 50 rupee discount if you are buying it online. There is a tranche that is released every month. There will be one that will be released next month and the month after that as well. So if you want to consider it as an SIP of sorts in gold, you could do so through the sovereign gold bond scheme. But what are the benefits? What are the disadvantages? What's the tax efficiency? What sort of returns as well can an investor expect if they invest in the sovereign gold bond scheme? Let's talk about that and more with Feroze Azeez, the Deputy CEO of Anand Rathi Private Wealth Management. Feroze, always a pleasure having you with us on The Money Show. Let's start off first with the basics of the sovereign gold bond scheme. What are the features like? If you could, you set the context and then we'll go more into detail with respect to the individual features.
I think you're right. Quite a few people now have started showing inclination towards the sovereign gold bond, and rightly so. This basically gives you a bond which the return of which is dependent on the gold prices. So it is nothing but a gold bond instead of a bar, a coin, or even a ETF, which is a gold ETF or a gold mutual fund. Sovereign gold bond replaces from ornaments to as much as a gold mutual fund. In a better fashion. So sovereign gold bond gives you a 2.5% interest per annum over and above the gold bond's price movement, which is related to the gold price itself. So point one, you get an extra return of 2.5%. Point two, it's a 7-year bond with an option to liquidate after 5 years. Point three is you can sell these bonds on the exchange at a price marginally higher or lower than the prevailing price, and it gives you a half-yearly interest which is taxable, and the gains which you make in the gold bond, if you've invested 100 rupees and in the next 7 years if you get back 150, for example, the 50 rupees is tax-free if held till maturity. So these are basically some of the features of the sovereign gold bond.
Okay. Now, Feroze, we do know the disadvantages of having gold, right? There's purity issues. We're worried about the security, the safety, etc., etc. But there are many others, so we do know that, an e-gold benefits over physical gold. But within the whole e-gold basket as well, you have ETF, you have even the government's gold monetization scheme. So how would a sovereign gold bond scheme win over, say, an ETF or any other scheme available for gold?
See, I think any product, irrespective of gold or equity or debt, needs to take 4-5 factors into account before we conclude which is a better vehicle to participate. So the first one is return. So there are about 4-5. Let me start counting them. Return. It gives you 2.5% over and above the gold price. So no other gold vehicle gives you an interest on a gold investment over and above the price. So on the return parameter, it's so good that the second in line would be far-fetched from this. So one, return is good. Second, the risk is identical to the risk you would have in a gold mutual fund or a gold ETF. So on risk, it's at par. On return, there is an extra return of 2.5%, which is not a small number, it's a big number. On liquidity, it does not score that well, Mubina, because when you try and sell these on the exchange, if you look at the last 3-4 CDs, they're quoting at a 4% lesser price than the gold price in the market. So liquidity is there, but at a cost of giving it away at a discount. So liquidity is bad, cost is very good. So these are the 4 most important: risk, return, cost, and liquidity, which you factor in when you evaluate any product for that matter. And I would say this is 9 on 10 from a risk, safety, return, cost, and liquidity perspective.
Okay. Now, we do know that obviously a sovereign gold bond scheme will essentially move with gold prices. But like you mentioned, if I go to sell it on the secondary market right now, it's at a bit of a discount, versus what the gold prices are at. So it lags the market rate of gold. If you could explain what's the correlation, I mean, how should you essentially assess what kind of return I will get in my sovereign gold bond scheme depending on how gold prices move?
See, one is you have to be very bothered about the discount if you're investing it for shorter spans of time. One relief is if you're a hold to maturity 7-year investor, which quite a few of us become, especially in gold and real estate. We have a tendency as Indians to hold them for long periods of time. So if you're holding it for 7 years, you anyways don't have to be bothered. Now that if you want to hold it for lesser periods of time, then comes the exchange into picture, and then this discount. So Mubina, it's a very valid question. So the discount, it's generally a discount of 2, 3, 4%. The correlation is very, very strong. It moves in tandem, but unfortunately, you end up getting less to the extent of the gold price in the market to the extent of 3, 4%. So they are very strongly correlated, but this is a laggard if you wish to sell it on the exchange by 3, 4%.
Okay, like you mentioned, Feroze, that these bonds are available on the secondary market. So I can actually buy it off online as well. But that brings about another question. This isn't the first tranche. The previous tranches as well have been subscribed by various investors. They are available in the secondary market, by the way, for cheaper than the one that we are getting right now. So I mean, why should I not simply buy it off from the secondary market, at a cheaper rate as opposed to buying it at 4,016 rupees, the current tranche?
So you're absolutely right, Mubina. If you have smaller quantums and if you wish to buy them, then you can certainly buy them on the exchange. And unfortunately, these are not very liquid, so the buyer doesn't get large quantities, or the seller does not get the desired quantity. The discount might, in certain cases, be academic because as soon as the buyers and seller comes, there is no reason why they should quote at a substantial discount. So you're right. If you can get the old series at a reasonable discount of 2, 3, 4%, then it's definitely worthwhile. But one thing you have to also factor in is that there will be an interest accrued on that bond. So I don't know whether the retail investor has the capability to comprehend the already built-in interest rate in that bond, which is there because the half-yearly interest payment would be getting accrued in that bond. So point one, if you're able to get the clean price of the bond, and if you have the capability to compute that, one. Point two, if you are able to get the quantity you desire, then definitely an older alternative would be a better one.
Okay. My next question, Feroze, is essentially, is this scheme tax efficient versus, say, other methods of buying gold?
I think the fifth criteria which I was referring to is taxation. Of course, on a tax standpoint, at worst, it will be equal in certain circumstances to the rest of the alternatives. But in most circumstances, it will be more tax efficient. If you're holding it to maturity, it is the best taxation possible, which is zero. You can't get better than zero. So it is so good that across different asset classes, across different platforms, only some insurance products and sovereign gold bonds today have zero capital gain if held till maturity. And this is certainly one of the only two available products in the country across all the product platforms, across all asset classes, which is zero on capital gain, which is not to be forgotten. Today, equity also has a capital gain of 11-12%, including the cess and surcharge, which you end up paying. So here it is zero. So if you have money being accumulated for 7-year objective, like a child's education abroad, so gold is a very good platform to collect it, and sovereign gold bond is the most efficient on a tax standpoint. But if the interest which you get is taxable, it is not tax-free. Only capital gains is tax-free. The 2.5% interest which comes to you on a 6-monthly basis, a percent and a quarter, gets taxed as per your marginal tax rate. So that's what you have to remember. And the third point is, if you're withdrawing your money sooner, this, what I told you as an advantage, which is the capital gain being zero, is not applicable. Then it is as good or as bad as other gold platforms.
Okay, now Feroze, we do know gold prices have gone up a lot. Like I mentioned, almost 40 to 1,000 rupees per 10 grams. So would you ask viewers perhaps to wait for the next tranche, which will, it's not that far away, it's next month, and, hope that, okay, maybe gold prices will go down then? Or do you think they should not play that whole price guessing game?
See, if you are investing a substantial amount, then it makes sense to spread your money across these two tranches. I would say that if somebody is perturbed by the prices at which he or she is going to be purchasing, it's always good to sit on the fence and break your money 50-50, because nobody knows what is going to transpire in the next 1 month and what will happen to gold prices. And because gold prices also have another variable, which is the rupee-dollar equation. Even if you understand gold very well, be rest assured, understanding rupee and dollar equation for a month to month is not an easy task. And if somebody says that he or she knows, I don't think it might be a right claim. So you can sit on the fence, put half your money in this tranche, put half your money in the next one, and leave the timing decision to God instead of yourself.
Okay, fair enough. All right, Feroze, thanks so much for joining in with your take on the sovereign gold bond scheme. Folks, it's a scheme open till the 17th of Jan, so take your decision accordingly. With that, we'll wrap it up on The Money Show. Thanks for watching.